Hi, I'm Adam,
This is Kevin.
and we are Tech Guys Who Invest. This is the place for business people and investors to learn all about investing. We offer a fresh perspective on what it's like to have a day job while investing, and we share lessons learned on our investing journey. Our vision is to educate and entertain you while adding tons of value to your daily commute. Welcome to our show. This episode of Tech Guys Who Invest is brought to you by Dreamstone Investments. Dreamstone is a multifamily real estate operator based in Atlanta, Georgia, and Tampa, Florida. Dreamstone specializes in finding and acquiring off-market value-add deals across the southeastern part of the U.S. Dreamstone creates immense value by ensuring the tenants are treated like residents and by adding the Dreamstone touch to each of our communities. To schedule a call to find out more about their current offerings and to see how you can partner with them, please send an email to info@dreamstoneinvest.com. You can also check out their website at dreamstoneinvest.com.
Welcome to another episode of the Tech Guys Who Invest podcast, where each week we teach you how to invest wisely and safely. Now, this week's episode is going to be the audio from our monthly webinar that Adam and I like to host. We are passionate educators, which is kind of the premise of the podcast. We want to share everything we're learning, from the books we're reading to the people we meet to the things that we are doing to help all of you learn how to take control of your financial success. This webinar was titled Creating Cashflow Through Real Estate. And I don't want to spoil it for you because there's so much power in investing for real estate. But if you want to sign up for our next webinar, all you have to do is subscribe to the show, and you can do that by going to tgwipodcast/creating-cashflow. So without further ado, here is the episode. All right, welcome everybody to the October Tampa Cashflow Meetup. And today we are going to talk about how you can invest for cash flow. And we wanted to have a little bit of a spooky theme since Halloween is right around the corner. Albeit it's probably going to be a different type of Halloween this year than, previous years, but we're going to make the most of it. So the agenda we have today is we're going to introduce ourselves. Who are the Tech Guys Who Invest? Who are Adam and Kevin? Then we'll talk about what it means to invest for cash flow. What is cash flow, first of all, at the highest level? Then Adam and I will talk about our respective investor identities, talking about cash flow through mortgages and multifamily. And then lastly, we'll wrap everything up with actions for success, things you can do today to get the ball rolling, because without action, there is no success.
All right. Thanks, Kevin. Most of you know me, Adam Yulry. I'm an agile business coach for my day job. And when I'm not doing that, I'm investing in multifamily. I'm a syndicator of large multifamily apartment deals. And I describe myself as a servant leader, which means I love to help other people and really serve them in a way that helps them grow.
Awesome. Well, I have a 9-to-5 also in tech. I am a software sales engineer. So the company I work for produces enterprise software where we help solve problems, process inefficiencies through our software. And I'm the individual who comes in and presents to the customers and prospects, trying to help them envision what their business could be like if they were to use our software. Outside of that, I'm a mortgage note problem solver. So I like being the bank. I love the fact that you can be the bank, you can control kind of the lending aspect. You don't have to worry about any type of maintenance, really. It's, hey, are you going to pay your mortgage or not? And if you don't, I'll take back the property. So not that I would do that per se, but I do like that component of it. And outside of that, I love personal development. I love reading about it. I love chatting about it. It's kind of more of like a passion project type of thing. You can find me reading about mortgages, investing, but also have in rotation personal development stuff. All right. So that is us. That is the Tech Guys Who Invest. That's who we are. And we're going to talk all about cash flow. But first, let's define what cash flow is and the way we like to think about it. And of course, there's technical definitions with regards to business and things of that nature. But at the end of the day, it's just the flow of money from one party to another. That could be between businesses. That could be between business to consumer. It's just the flow of that money. And positive Cash flow is income or profits, and negative cash flow is expenses or losses, liabilities, if you think about it in that way. So it's really simple when we talk about cash flow. That's what we're dealing with today. So another way to look at it is if you have a 9 to 5, you have cash flow, right? Your 9 to 5 is paying you. They are transferring money to you. And of course, if you're here, you're looking for ways to either supplement that if you absolutely love your job, or you're looking to kind of give yourself that freedom. And as employees, which all of us are, we're trading our time for this cash flow. That's the agreement that we have with our employers. But the better way, or a better way to create cash flow, is by buying assets. Now imagine that these assets are the ones that are giving you that money, that income. That way you don't have to work if you don't want to.
So let's talk about what an asset is. An asset is commonly defined as something of value, right? Robert Kiyosaki defines an asset as anything that puts money in your pocket. I love that simple definition by him. And he defines a liability as anything that takes money out of your pocket. Now, the big mistake that poor and middle class people make, according to Kiyosaki, is spending their lives buying liabilities instead of assets. Think about all your friends who are driving BMWs and Mercedes around, but they don't have cash flowing investments, right? That's kind of out of balance. Now, most people think investing in assets means buying stocks or bonds or mutual funds, savings accounts, or even a primary residence. So when considering your primary residence as an asset, I refer to Kiyosaki's definition. Does it put money in your pocket or take money out? And be sure to account for maintenance expenses when determining this, which most people don't. So I don't want to go too far down that track. But regarding stocks and mutual funds, if they are profitable, they tend to appreciate over time and not really pay a stream of cash each month, right? They kind of appreciate or accumulate. And appreciation is not cash flow. Accumulation of piles of cash are not cash flow. Both of these require you to wait a long period of time for enough money to accumulate so you can begin siphoning off money to pay for expenses. Cash flow, unlike these, is stable, it's predictable, and best of all, it pays you now. But why is that beneficial? Kevin's going to explain that right now.
Don't you want to get paid now? All right, that's our presentation, right? You want to get paid now and you want the benefits of cash flow. One of them is going to be that it can pay for your living expenses. If you took a list or a budget, if you will, of all the bills that you have, all the expenses, the liabilities that you have, you could replace that with an asset that is going to pay for that. Let's say your internet bill is $60. You could buy an asset that's producing $60 a month. Then your internet is effectively paid for. Your mortgage, if you can generate enough money to pay for that mortgage, that's a living expense that's covered. At depreciation, you can't really do that, right? You have this large amount of money that's just going to get eaten away as you continue to live. That's not really freedom, in my opinion, if all you're doing is worrying about how much you're going to be spending. Cash flow can offer you that freedom of time where you can do whatever you want. You know that the money's going to be coming in. It's paying for this trip. It's paying for you to go out to eat. It's budgeted. You have that option. And you can get paid with cash flow wherever you are, right? You could be in Timbuktu. You could be in the South Pole, and you would still collect that cash flow. And as Adam mentioned earlier, it's more predictable. With multifamily, for example, if you have 100 units and you've underwritten it for a 85% occupancy, you know that there's a good possibility that you'll get 85% of that cash flow regularly. And then mortgage notes. If you have a borrower that's paying and you have a note for the next 20 years, there's a likelihood that they would continue to pay that 20 years of principal and interest every month. So we're going to talk about first with cash flow with mortgages, but I want to define what a note and a mortgage is. So the note investing space or note industry, if you will, is really common. If you've ever owed money in any way, shape, or form, whether it's a student loan, a credit card loan, a car payment, you've been in the note business. The only difference is you're the borrower in that case. And I'm sure you remember signing something. I vaguely remember signing something for my student loans. For a credit card, you have to sign something, right? That same thing holds true. It's a contract between you and the lender, you and the party that's lending you money. Or in this case, speaking more broadly, it's between a borrower and the lender. And within that note, there are going to be terms, right? Taking it back to a credit card, you have the interest rate that it tells you. It tells you what the payment will be, the penalty will be if you do late payment. If you log in online, it'll tell you this is the minimum you can pay to make sure that you can cover this or whatever it may be. So a note will have all of those terms. The difference between a note and a mortgage and credit card is the credit card is unsecured debt. So if you were to default on your credit card, you stop paying, it's not like the credit card company is going to come take your house, right? They, to my knowledge, they can't. But with a mortgage, what the mortgage does is it secures the lender's position. So the mortgage ties that promise to pay that the borrower has with the lender to a property. So the lender is protected by that asset. If the borrower ever defaults, that lender can take it back and kind of be made whole. So when we're talking about notes, basically we're talking about notes and mortgages when we say notes colloquially. And when you're talking about notes, they can either be performing, where the borrower is paying monthly, that principal and interest. So if you think about the mortgages you have, 30 years is kind of the most common one, right? So 30 years months is what, 360 months. Assuming this person is going to continue to pay for that amount of time, you have 360 months of monthly payments. But there are non-performing notes, and investors buy that. But you're not generating cash flow right away with a non-performing note, so we won't talk about that because it's a little bit more nuanced. But you can get either into performing or non-performing notes. So as I mentioned earlier, the cash flow when you buy a performing note, even one that's already originated. Let's say I have a note. Currently, I have a note that's a 10-year note. I could sell this note to one of you for the cash flow if you wanted it, and I can recoup my capital. And you would get paid that next month, the cash flow that I was getting paid. And if you want to take one note and turn it into multiple streams of income, there are a few ways that you can do that. You can sell a partial note. And I won't go into too much detail, but a partial note basically is instead of getting 36 payments or waiting for 360 payments, 360 months to get your money back, you could sell the first 60 months for a chunk of that discount, basically. So you get some of your money back, you give up that cash flow, but you can buy another note. I think a lot of people forget that notes are assets and you can borrow against that. I'm not saying that Wells Fargo or Citibank will say, hey, you will loan against your mortgage that you own in your investor portfolio. But there's trillions of dollars in IRA money where you can find an investor where you say, hey, I have this note that I borrow against, 50% loan to value, and you can go buy another note. That way, instead of a partial, you're not giving up that cash flow. You're just using it as an asset to go buy another note. And if you can create a spread with that investor, there are investors out there that are happy with 6% interest. Well, what happens if you find a note that's paying 8% interest? You're thinking that's a 2% spread, but you have no money down, no money into the deal. So that's an infinite return. So with notes, there's a lot of ways that you can create cash flow. As long as you're buying those performing notes, you'll get paid right away.
All right. Thanks, Kevin, for teaching us a little bit about cash flowing with notes. Now I'm going to talk a little bit about cash flowing with multifamily. So I'll start by explaining that large multifamily, which I'm talking about commercial multifamily, which is 5 units and above. The way that typically works is there's a sponsor who finds an apartment property for sale. And a sponsor's like a team who does this. Typically, they're professional investors who do this for a living. For example, a 90-unit property that rents to working class residents, right? The sponsor will go and they'll analyze that deal. And if it's a profitable deal, they will buy it. And then that basically requires an equity raise. So it's not too different from buying a house in the fact that the bank will lend up to a percentage of the value of the property. And then the rest, think your down payment if you're buying a house, that needs to be raised by the sponsor. So that's where passive investors come in. Passive investors are people who are looking to contribute capital, but not do all of the work on an investment. And it is a ton of work. As someone who's doing that actively, I can tell you, It requires a team of experienced operators. It is a lot of work. Passive investors, though, contribute capital in exchange for a piece of the deal. And because it's truly investing in real estate, investors get all of the benefits of they get cash flow, they get tax benefits, equity appreciation, debt paydown. Now, essentially, passive investors become a limited partner or an LP in the company that's buying the property. So they're literally owners of the real estate. In that example I gave, they would literally own a piece of the 90 unit property as a limited partner in that company. And that's why they get all the benefits that I mentioned, because they actually own the real estate. And this is really one of the fastest ways to grow wealth. It's one of the reasons I like it so much. Since most of these deals are structured so investors can exit the deal in 5 to 7 years, investors can then redeploy their capital plus the additional returns they've made into another deal. And you can really get the snowball effect going. Now, for cash flow, which is what we're here talking about tonight, the dividends that you get from a deal like this, it's most common that they're quarterly. Now, monthly can happen, but they're less common. It does exist, though. Dreamstone Investments, the company that I'm working with, has an investment right now that pays monthly dividends. In fact, I get my payment next week. It's one of the best feelings you get is seeing that payment show up. But one of the many nice things about passively investing in syndications is that you invest your money and then you collect the cash flow during the life of your investment. You receive tax benefits each year. And at the end of the deal, you get a payout of the equity distribution. So it's just paying you many different ways. You receive communications from the sponsor regularly. At Dreamstone, I'm responsible for that, and we send them monthly. And that keeps you informed of the business plan and performance. And more sophisticated sponsors like us provide an investor portal so you can see your current metrics and performance of your investment at any time. And investing in this way, it really is a passive way to invest. And it beats the pants off investing in mutual funds with hidden fees, right? So also another thing to mention in a lot of these investments is that that capital might get returned to you before the deal ends. So in a lot of our deals, we have it built into the business plan where the investor capital gets returned after a few years, maybe 3 years, for example, right? But then you stay in the deal and continue getting the cash flow. Even though you got your initial investment back, you go redeploy that somewhere else. Maybe you buy a note with Kevin. Maybe you invest in a duplex, or maybe you invest in another one of these syndications and just have that start working for you while you're still collecting cash flow for the next couple of years until the team exits that deal. And then you share in the equity appreciation that they got during that time. So it's just an amazing way to invest.
All right. So we wanted to talk about no problem. We want to talk about these actions for success. And as you can see, the first one is to get educated. And you may have questions. And of course, we want to address those. We'll save those towards the end. We're almost done with this presentation. So go ahead, Adam.
All right. So how does one get started? Right? You might think our advice would be to go out and invest immediately. Maybe invest with one of us right away, but it isn't. That's not our advice. Our advice is to get educated, which is why it's fantastic to see you all here tonight, because that's exactly what you're doing. It's very important to clarify your goals, understand very clearly what your goals are, and then identify an investment type that aligns to those goals. As you just heard tonight, there are two very different investment types, right? And they align to different goals you may have. And there are umpteen other ones out there. We just covered the ones that Kevin and I specialize in. But what you want to do is choose an investment type that aligns to your goals. And then you want to you really educate yourself on that investment type. Once you've identified it, dive in and really learn a lot about it. And it's not because you're going to go be an active investor per se, unless that aligns to your goals, right? If that's what you want to do, go for it. But if you want to be a passive investor, you want to understand exactly what you're investing in before you actually invest. syndicators like us will send you an offering memorandum and an investment packet that has all the details that an educated investor can use to make a good decision about whether this is something they want to invest in. The deals Kevin does, same thing. Like, he'll share the details with you, and then you can make a judgment on whether you'd want to make that investment. You need to be educated and understand what you're looking at in order to make those decisions.
And speaking of education, the resources are out there, and investors are always looking to market. So that means that whatever niche you're thinking of, as specific as it may be, I can promise you there's somebody out there that's doing it. So you can learn from them, learn from somebody that's already done it. There's podcasts, there's YouTube channels, there's books, there's audiobooks if you don't like reading. There are just so many ways that you can get educated. You can also reach out to investors, right? Sorry about that. So, and we think about cash flow, think about how you can create that income that we were just talking about, how you can produce cash flow for a variety of ways, and what that cash flow can do for you. It's a different way of thinking, right? If we're traditionally thinking about investing in like a 401k or buying stocks, bonds, and mutual funds, yeah, they may pay dividends, but not to the same extent that you can get cash flow monthly like you would with a multifamily opportunity or with mortgage notes. And one of my favorite actions for success is ask why, right? Investors will talk about their deals where they were successful, but they'll also talk about deals where they failed. You can ask them, hey, just out of curiosity, I heard you on this podcast, or I saw your post on Bigger Pockets or on Facebook. I want to learn kind of why you did what you did. And I'm willing to bet they're most likely going to be willing to explain that to you. I know I would be, and I'm sure Adam would be too. Knowing that reason why, it can kind of breaks it down more technically. You start to see the details that aren't really posted on social media, or you can dive deeper in that with the investor.
Absolutely. And last is probably our favorite tip, maybe other than get educated, which is take action. So once you have done the above steps and you feel like you're ready to go, it's really important to take action. Now, what a lot of people do is they get educated and then they don't take action. And a lot of times it's fear holding them back, quite honestly. They've got some mental barriers they need to break through, because it's really easy just to assign a little piece of your paycheck, and that, behind the scenes, sort of almost out of sight, out of mind, goes into some account, and it's just, accumulating and buying these mutual funds, right? But then to actually take a big chunk of money that you've got and invest that feels scary the first time, even the second time, right? But don't let fear hold you back. Again, if you've educated yourself, and the numbers don't lie, and to you, those numbers mean that it's a good deal, and you're ready, do it. Take action. Don't let fear stop you or hold you back.
And if you need another set of eyes, if you're thinking of, hey, I might do this note deal, I'd love to get your opinion on it, reach out to me. If you're looking at this, maybe investing in a syndication or looking at a multifamily deal, reach out to Adam. We're here as resources. And that might be enough action. Booking a time on our calendar, listening to a podcast episode. Action doesn't have to be this massive grand slam of a swing at bat, right? 4 singles is a home run. So as long as you're taking those small swings to get on base, if you will, then that's action. And enough of those will lead to massive success. So when we talk about what we covered what cash flow is. We defined it. And then we also talked about cash flow with mortgages and multifamily. And then we also talked about the actions for success, things that you can do today. As soon as we get off of this webinar, there are things that you can do, whether that's go read, whether that's reach out to us, whatever you can think of, that's available for you.
All right, guys. So if you have more questions about what investing, or if there are ways we can help you, if you want to network with other people, reach out to us, email us, techguyswhoinvest@gmail.com. Also, we'd love it if you checked out our podcast. A lot of people get value from listening to it. We've had a ton of good guests on. I know tonight, a couple times we've sort of mentioned investing through a 401k, and what we mean there is self-directed 401ks, IRAs, solo 401ks, QRPs, and things like that. Most people don't really know what that is. We've had a few really great guests on who explain all that stuff, and just a lot of interesting, neat topics on the show. So we encourage you to go check out the podcast if you haven't listened to that, and let us know what you think.
And if you hear a show, you listen to a show and you think, oh, I like this guest, chances are that guest has said, hey, you can reach out to me here. So you can reach out to them with the specific questions you may have. And generally speaking, they love that because it shows that you care about what they're offering as far as what the knowledge they're providing, the value they're providing. It shows you're doing your research. It shows you're taking action. And I can promise you that from my experience, at least, when somebody is taking action to help themselves, I am more willing to help them versus somebody just asking for a handout. And you're thinking to yourself, I don't have time for this. But if you see somebody making the effort, there's more of an incentive, at least in my opinion, to want to be able to help them succeed. So that's who we are, the Tech Guys Who Invest. If you want to learn more about us, you can go to tgwipodcast.com/about. Our bio is there, what we like to talk about, what we enjoy. And we have bonus content for you. We're talking about a lot about, investor identity and how it's so important to know what you need to focus on, because we all have some types of constraints. We all have weaknesses and strengths as well, right? What I'm strong at might not be what you're strong at. You may have this knack for analyzing deals that you're just way better than I am, or whatever it may be. But we created a canvas for you to kind of help push you in the right direction. It's completely free. We really would love for you to check it out. This was created because Adam and I look back at things that were difficult for us. And I can tell you, I jumped around a lot when I first started listening to Bigger Pockets, for example. I first thought, I wanted a house hack. And then I said, Airbnbs. And then I learned about mobile homes. And I was like, oh, wow, I can do all of this. And eventually I settled on notes because it fit for me. It fit my personality and what I wanted to do. It aligned with the goals that I had. And that's how I kind of just said, all right, I'm going to laser focus on this. So check it out. We also would love feedback. So canvas.tgwipodcast.com, and you can get it for free. And that does it for this week's episode of the Tech Guys Who Invest podcast. Really, what we wanted to do with the webinar was explain how powerful investing for cash flow is. We hope that we got the gears turning about how you can create cash flow. And in real estate, there are so many ways that you can create cash flow, but Adam and I are going to speak from the things that we know the best as part of our investor identity. Adam knows how to create cash flow through multifamily apartments. I know how to make money through mortgages. That's what we do best. So if you have any questions about anything you've heard about the webinar or anything that you hear about throughout any of the episodes, don't hesitate to reach out. We love being resources for you. Send us an email at techguyswhoinvest@gmail.com. Thanks, everybody.